Hi everyone, welcome to the third episode of our series, Finance for Startups. One mistake that a lot of SaaS startups do is they confuse between the cost of goods sold, written as COGS in the financial statements, with operating expense. If you're putting a developer salaries under COGS, you're missing the big picture, you're missing the basics. COGS is not what it takes to develop the product, it is what it takes to deliver the product to your customer. Your developer cost is typically an R&D expenses. We'll go into the details of this. Today, we'll talk about P&L statements, profit and loss statements. Let's take a quick look at a P&L statement of a typical SaaS startup. It's a small company, uh, nothing complex, no loans or any complex accounting. A simple company which has all typical transactions that you do. They pay their rents, they pay for their internet, electricity, they pay for the cloud cost, they pay for API cost, maybe they're using some third-party API services. They have revenue, they do an office party once in a while, they use uh, emailing systems, let's say Zoho or Google, something like that. They have an accounting system, maybe Zoho, maybe Tally. One of those, they pay for HR softwares, maybe payroll, attendance, back one of those. They pay their developer salaries, they spend some money on marketing, and the founder is taking a small salary here. The same pattern repeats for all months. Let's say this for the financial year 25-26, the same pattern repeats for 12 months. April and May is more or less identical. In June, you would see a new entry called sales commissions. Let's say the company engages a third party to do the sales for them, or they partner with someone else and pay a commission on the sales they do. So such expenses are called as sales commissions. This is typical for most startups, and this is what you would give to your CA for your annual preparing the annual statements. Now the CA will most likely come back to you and ask for a categorization. What exactly is a category? You have a lot of expenses, and you need to say, all right, this expense income or expense corresponds to this, falls under this specific head, or this is of this nature. That's called categorization. You can see a column C where we have added a column called category. Items like the rent, internet, electricity, they are straightforward. Where we see a bit technicality is, let's say you do an office party. What does that expense go into? Is it entertainment? Is it, what exactly is this? People typically put it under administrative expenses because it's part of running your office. Uh, the email and HR software that we talk about, it typically falls under softwares that you pay for. You can call it softwares in category. The developer salaries are typically marked as R&D because they are developing products for you. It's a part of your future investment. Marketing is straightforward. Founder salaries either fall under administrative or R&D, depends on what nature of work they do. I mean, if you're a founder and you're writing the code yourself, your salary could fall under R&D. And if you are doing other activities, let's say you are actively managing the company, you are doing sales and everything, you could put it under administrative. So it depends on what task you do in the company. The second column is called major categories. The category will broadly give you, okay, the category is more specific. I mean, okay, this is rent, this is internet, etc. Major category is, I mean, this is not a standard accounting practice. I'm explaining it for more of an explainer. There is a standard format that we use for P&L statements, and in P&L statement there are certain heads, standard heads as per the accounting standards. uh, the categories would be clubbed together into one of those major heads. So let's say you would club your administrative expenses, software expenses, everything under something called SAG, selling, general, and administrative expenses. Your CA would advise you more on this, on how to do what categories to use. Uh, then you can do that. You can do the categories accordingly. Now, we have transactions for 3 months, and based on this 3 months of data, we are preparing a P&L statement. For your convenience, I've already prepared it for you. It's the same numbers, just translated into a better format. Your revenues here has been added up under revenue, and like that. Your cost of goods sold, as I explained earlier, cost of goods sold is what it takes to deliver the product to your customer. Let's say in a SaaS setup, you need to have your cloud infra to so that your consumers can use it. You could be paying for API costs without which the app may not work. Maybe it's a some monitoring system, some LLM model, could be anything. So this is basically the breakup of your costs. Your 1.9 lakhs comes from these two. You have your revenue, you have a cost of goods sold, and if you subtract it, what you get is called operating margin, operating profit. From your very basic operations. We'll talk about other expenses later. And your operating margin is your profit expressed as a percentage. This company has a very healthy operating margin of about 92%, which is typical of SaaS companies. You're left with this 20 lakh to run the rest of your company. You have SG&A, selling general and administrative expenses, as I told you earlier, and these are the items which would add up to SG&A. It adds to 5.46 lakhs, and we have put R&D, the developer salaries, as a different item. Some companies may put R&D under SG&A. That's also fine. In this video, for you to understand the difference, I've kept it separately. From your operating profit, when you subtract all other expenses, you get you get PBT, or profit before tax. You pay your taxes on the PBT and you're left with 1.6 lakhs after taxes. This is what the company finally made in the financial year. Let's take a slightly different example where instead of putting R&D under SG&A, you're putting R&D under cost of goods sold because you assume the developer salaries are required for the product. The same numbers, if you move this R&D from here to the COGS, let's see what happens. I've already prepared the version of that. It's the same number, just that the developer salaries has been moved to the top. What happens is your operating profit, which was about 20 lakh earlier, dropped drastically. Now you only have a margin of 34%, whereas earlier you had a margin of about 92%. Your final profit after tax remains same. The significance is when an investor or an interested party is looking at your books, when they see the first version of the P&L, they see a company with healthy operating margins, whereas when they see the second version, they see something with very less operating margin. So all of a sudden, in the second version, your company becomes less attractive or less interesting. This is why the categorization of expenses is very critical. Before we wind up, let's look at one controversial subjects. Do founders themselves take salary? It's different people give different answers for this. My simple take is they're people, they have rent to pay, they have bills to pay, they need salary. So they need to take a number, they need to take something out of it. Another version might say, hey, they are shareholders, they make profit when the company grows big. So why take salary? I mean, there is nothing to or against either of these arguments. It all depends on what philosophy you operate in. I mean, as a founder, if you believe in salary, that's your call. If you don't believe in salary, that's your call. Uh, let's say you're taking salary. In this example, you're taking a salary of 50,000 rupees. For discussion, let's change this number to 1 lakh. Instead of 50K, you're taking 100K as a salary every month. Right? You can just copy this number to all three. Let's see what exactly changed in the P&L because of this change. When you go to the P&L version, your revenue COGS, no change. Your operating profit, no change. The change happens in administrative because your salary was categorized under administrative expenses. Your PBT and PAT reduced drastically. Now, if you're playing a game where the entire valuation is based on revenue multiples, you could argue that this does not make any change. Your valuation is based on some revenue multiple, let's say 10x of your revenue, 20x of your revenue, not based on PAT. That's one argument you could make, but please keep in mind that all investors don't buy to your revenue multiples. Some may look at PAT multiples also, or there are other terms like EBITDA multiples. Some may look at that also. So this could be okay, or this could be backfire depending on your specific circumstances. In this example, we haven't considered items like debt. Let's say the company has taken a bank loan and it needs to pay back the interest. We haven't considered those complex issues in this episode. We'll look into it on a later episode. In the next episode, we'll have a look at a balance sheet because PAT from the P&L statement will go to your balance sheet as retained earnings or dividends, as the case may be. We'll discuss about that in detail in the future episodes. So hope you enjoyed it. Follow for more informative videos like this.